Welcome to the introduction to Fibonacci. You see it in nature, you see it in your daily interactions, and yes, Fibonacci exists within the market. This video is going to be introducing you to what the Fibonacci is used for, the different ways that you could use the Fibonacci tool, as well as which Fibonacci levels could be considered. In a later training, we're going to be diving even deeper into the fractal nature of the fib, as well as giving you a little bit more insight on which specific actions you can take to get even more precision with your entries, as well as exits in the market by using the fib retracement tool. On TradingView, there are a lot of different Fibonacci related indicators. We're going to be focusing on the fib retracement for our measurements in this introductory video. The Fibonacci retracement tool is used to measure a move from a low to a high or from a high to a low. In this example, we've got the US dollar Canadian on the daily time frame. If we were to identify our low, we could agree that the low of 2020 is down here. The high, as of the time of this recording, is up at these price levels. So now that we've identified a low and a high, we could take our Fibonacci retracement tool and we could go from the wick of the lowest candle all the way up to the wick of the highest candle, and it's going to put some different price lines on here for us. Each one of these Fibonacci retracement levels holds significance in the eyes of market participants around the world. When we're measuring the move from this low to this high, or from any low to high or high to low. When we look at the levels, this one right here, for instance, 50%, what that's indicating to us is that between the two price levels that we have measured, that is right in the middle of it. You could also utilize the fib tool in the same way, but rather than incorporating the wicks, you could go from the body of your low to the body of your high. The reason why you might want to do this is because generally the majority of trading action occurs within the bodies of the candles. It really comes down to a personal preference. We can see it doesn't change it all that much. The middle of that measured move from body to body would be at this 50% level rather than at the purple line that we added the other minute. The Fibonacci tool can be used in a variety of ways, whether you're measuring from lows to highs, from highs to lows, whether you are identifying things such as gaps that occur in the market and you want to go and look at where the gap began to where the gap ended, and you want to measure that out, we can mark up, say, the middle of that right there and use it at a later time in our analysis to see what kind of reactions occur if we end up trading through the gap. Is it respected? As we can see in this instance, that is one way that you can use the Fibonacci tool to help you understand how price action may react when we are trading around a gap. If we were looking at something in the stock market, say we were looking at Tesla, or Apple, or Amazon, And we wanted to have an understanding of what type of movement has happened. What I'm going to do is I'm going to draw this up. Let's just say the market was trading in a sideways range, and then a breakout happened and we saw the market trade up higher than where it was previously at. We could measure from our low to our high, and let's assume for a minute that what we've drawn up from when the market started to trade higher, let's just say that this was a $10 increase in the price. So maybe the stock went from $1,510 up to $1,520. So a $10 increase in price. If the market were to retrace down to the 23.6 level, what initially started off as a $10 price gain now would only be a $7.64 movement. If we continued retracing down to the 38.2, we can use our handy dandy calculator tool to understand that the initial $10 price change, if we retraced 38.2% of the way, now the market would only be up $6.18 more than where it began. It's the same thing if we were to continue going down to the 50% level. Initially, we started off with a $10 gain. We retraced half of the way back. So now the market is 50% higher than where it started. Or it would cost you $5 more to purchase here than it would if you purchased where the move started. As the market retraces deeper and deeper into these levels, you can consider it as if you are getting a better buying opportunity. You're giving yourself the possibility to get in at a discount once the market has confirmed there is some probabilities of moving in your anticipated direction. The Fibonacci tool is incredibly powerful. What you can begin to do is implementing the Fibonacci tool. Measure from your lows to your highs. Measure potential manipulated moves, whether they are gaps, whether they are liquidity captures. There is a lot of information that can be gained from using the Fibonacci tool. And if you are wanting to mirror the settings that I've personally used within this video, you can feel free to do that. We've got some of the significant ones on here that most traders use, such as the 23.6, the 38.2, the 50%, the 61.8. And I want to expand on this one for a minute because a lot of people refer to that as the golden ratio. Many people use the 61.8 as a confirmation for a key reversal level. Now, I want you to realize that these levels should never be relied upon exclusively. It is incredibly dangerous to assume that if price trades to something like the 61.8%, that it's going to just suddenly immediately reverse. It is incredibly dangerous to assume that. So trades should never be taken exclusively off of Fibonacci levels. They are just a very helpful way for us to better visualize what type of movement has happened relative from one price point to the next. A couple of other levels worth mentioning. We have the 78.6 on here, and we also have the 88.6. If the market were to do a 100% retracement, that's when we would start getting into the extension levels, such as the 127.2, the 141.4, the 161.8, and then we also have the negative numbers as well. But we'll be diving deeper into that in a later training video. Fibonacci. It exists in the markets. The markets are fractal, just like what we will see in nature. And by having an understanding that Fibonacci plays a significant role in the psychology of people who participate in the markets all around the world, by having this understanding and by starting to implement Fibonacci measurements onto your charts, it's going to give you an advantage when you're looking for that extra confirmation to get in or out of your position.